Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Paul Sweeney, along with Tom Keene. Join us each day for insight from the best in economics, geopolitics, finance, and investment. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show. Weekday mornings from 7 to 10 Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen. And as always, on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app. Ken Leone, Research Director at CFRA, joins us here. Ken, what do you make of the results from Mickey Mouse and Friends?
Great to be with you. And this was a good block and tackle quarter. It showed progression on the broader financial metrics of reducing costs and getting to their target this year of $8 billion of free cash flow. So there's financial discipline at Disney. But of course, as you've noted, there's a lot of moving parts. And ultimately, what investors would like to see is growth that can get through this transition of linear networks declining, streaming businesses increasing, but how profitable will they be?
How profitable do you think they're going to be?
It's going to take time. Streaming is a very competitive business. Unlike other subscriber businesses of the past, like cable TV or even wireless, you have very high churn. Disney at least is disciplined on the programming and content spending, which has come down significantly, and in many cases, pivoting their spend to sports from general entertainment. But I think the jury is still out there, and what we didn't see in the release today is, the magic is there, but what investors want to see is how is Disney executing on a technology platform, not just US or global? Is there an AI component to their technology plans? And you know what? Netflix is doing that, and they're there. So if you're going to be great at streaming, you have to be like Netflix.
Hey, Ken, I guess, one of the challenges for the Walt Disney Company and pretty much most of the traditional media companies is just kind of that linear TV, broadcast, cable television business. And Disney reported, weaker results. Sales fell about 8% in the quarter. How do you think these traditional media companies kind of manage the longer term decline of those businesses?
So what we're seeing, and it's a great question, and if we were all in business class, this would be a classic where you have a mature to declining business, but it's still throwing off lots of cash, trying to reinvest that in new growing businesses that hopefully have good business models. And I think what we're seeing is because of digitalization of advertising, that shift from linear or legacy networks broadcast to streaming is happening much faster. So that's a problem.
Paul, you are a recovering media investment banker,
yes.
Right? I mean, I've heard about the death of linear forever. Yeah. So, I mean, what do you think makes this time different when you look at the outside?
What makes this time different is simply the revenue stream, which really supported television for the last 30, 40 years, was subscribers from cable television and satellite TV. And that subscription revenue offset the decline in advertising revenue as advertising revenue went to different places. First cable and then did digital. Now that subscriber revenue is going away because of the cord cutting. So now you really have nothing to lean against. And that's what I guess most of the media companies are kind of dealing with their linear networks. So Ken, I mean, if you're the Walt Disney Company here, one of the things is the studio. I mean, the Walt Disney Film Studio dominated Hollywood for the last 15, 20 years, thanks to the Star Wars and the Marvel and all this, the Pixars and all that kind of stuff. The studio kind of stumbled over the last 4 or 5 years, and maybe people are getting a little bit tired of some of the titles and the franchises.
They just need to be good. I'll go see it. Just be good.
Exactly. Okay, well, there you go. So what do you think the strategy is there, Ken?
So we need to see better performance, not only from Disney, but also the industry. And really, when you look at global box office, ex-China, it's running 20-25% below where we were pre-pandemic levels.
Yep.
Additionally, when you look at movies, you always go to the sequels, the ones that can bring in large audiences. but sometimes they're flops and they're very costly. So I think theatrical, which for Disney feeds not only into film, but it feeds into the genre of their parks. It's a big deal. And I think when we look at what Bob Iger wants to do there, he has talented people now running those businesses. But even if you got a big hit, you look at Paramount with Top Gun Maverick over a year ago, it has not that much impact on the stock or what analysts think in terms of the fundamental outlook of a company. So it's important, but it's kind of stirs the pot, but it's really, let's not forget, we haven't had a conversation today. Why many investors are in Disney is for experience or for the parks and having these durable businesses where they have less competition versus some of the problems they have in entertainment, whether it be film or be streaming. So let's not forget about the parks, because that's really the core of their stability.
I mean, let's be honest, guys. Maverick had an issue because of Barbie. I mean, that's what really happened. Barbie trumped Tom Cruise. So let's call it. You mentioned something earlier, and I wonder how that's going to tie into the parks experience, but also you mentioned in terms of streaming, and that's the AI component. How would AI help Disney do all the things you just said?
There is incredible work that I'm sure Disney is doing to be competitive and on par to great companies, whether they be Amazon, Meta, Google, or Netflix. So it's an enormous effort on the technology side to have intelligence for personalization. And I think AI will play a role in personalization of subscriber viewership, but they can't tell that message because they're playing multi-year catch-up to the companies I've mentioned. So it's a big deal. Right now, it's a competitive weakness for the traditional entertainment companies. You have to remember, Netflix has been at this for well over 10, 15 years. And of course, the names like Amazon with AWS, they're in the linchpin with AI. So that will get the stock up more than, it's interesting, in my earnings note, I said, maybe we'll get a profitability in streaming this quarter instead of the fourth quarter. We did, but it was small. So, we have to see what's next, for Disney in coming quarters.
All right, Ken, thanks so much for joining us. Really appreciate that. As always, Ken Leone, he's the Director of Research at CFRA Research. We appreciate it. Let's check in with our next guest here, Steve Eisman, Senior Portfolio Manager at Neuberger Berman. All right, I'm looking at, I guess, Steve, you were on the Odd Lots podcast recently, and you said that you are bullish on stocks that gain from artificial intelligence power needs. What does that mean?
Well, good question.
Thank you. I'm front-running Alex, because Alex is our energy guru here.
The current GPUs use about 3 times more electricity than your typical CPU. So the grid in the United States has been under pressure now for years. Utilities keep increasing their CapEx budgets, and now you've put an entire new pressure on the grid. So whatever money is being spent on the grid is going to keep going up probably for the next 10 years. So just to give you just one stock, for example, when utilities announce that they're increasing their CapEx budgets, utilities don't actually do anything. What they do is they send you electricity and send you a bill. But in terms of construction, that's done by a company called Quanta, which is the largest engineering construction company for utilities. So
Quanta.
The only thing I would tell you is that every time the CEO gets on the quarterly conference call, he just looks happier.
That's fair.
Yes.
If demand's going to grow 5-6%,
he doesn't know what to do with himself. He can't satisfy all of the demand. So that's just one example, but there are other companies that benefit as well. But I think there are 3 major themes of our time: AI, infrastructure, and crypto. And I believe in the first 2, and I don't believe in the third.
So just for framing here, you really made your name through the housing crisis and betting against housing debt back in 2008. You're portrayed in the Big Short film by Steve Carell.
I had to bring that up, but okay.
I did, but just to give context, if our viewers or listeners don't know, like you have a history of betting, having contrarian bets that pay off big time.
Yes.
What would be that contrarian bet? Out of the three things you just said, what's that big contrarian bet?
I don't have a contrarian bet here. I mean, I don't like crypto.
Not liking crypto feels contrarian.
Well, it's contrarian in the sense that I don't believe in it. I think the whole thesis behind it is wrong. But shorting a cult when there's no data to prove that it's wrong is a death wish. So what do I mean by that? So when I bet against subprime mortgages, every month securitizations produce data. Mm-hmm. They give every single credit quality data possible. So every month you could check, is it
like
getting
there were
worse?
Facts you could look at to back
every
up.
month you looked at the fact, and that fact, credit quality, was the major determinant of the value of subprime mortgage paper. So you had a data point every month, a massive data dump. Crypto trades on Ether. Mm-hmm. What does it trade? The thesis that crypto is that it's a hedge against fiat currency. So it's like digital gold. But it doesn't trade like that. It trades in perfect correlation with NASDAQ. So it trades against its own thesis. So what data point is there to show that crypto is wrong? I mean, if the deficit came down, it's not relevant because that's not how it trades anyway. So there's nothing to do.
What's your macro call here? I mean, there's a lot of folks in the marketplace saying, this Federal Reserve is going to cut rates in 2024, maybe not as many times as we originally thought, maybe not as much as we originally thought, but that this economy is in good shape, but still there might be some rate cuts here. Is that kind of the backdrop that's for you, or how do you think about it?
I mean, the way I think about it is that Powell is a dove. He has always been a dove. Raising rates was completely against his nature. He wants to cut rates because he always wants to cut rates. The data is not completely in his favor, so maybe they cut once. Mm-hmm. Do I think they should cut it all? I would wait, but trust me, nobody consults me.
No one consults us either. It's very strange.
So I think they'll probably cut once, is my guess.
Mm-hmm. So does that affect the thesis that you have, like the infrastructure, the power demand,
and AI in general,
and AI in general? Does what the Fed does
it's irrelevant.
It's irrelevant.
It's completely irrelevant.
Does it change how you play those themes or
not
the
at all.
Timing? Okay.
I mean, this is what I think. Credit quality in the United States is fine, other than office real estate, and office real estate is not big enough to sink the economy. It's a problem. It's a regional problem. It's a regional bank problem. It's some investors' problem. The consumer's not over-levered. The housing market is not in fuego. Mm-hmm. There's a shortage of housing. So the financial system of the United States has never been this healthy in anyone's lifetime. Period. So all the things that existed prior to 2008 don't exist today. You have a very dynamic economy with some very, very powerful themes. The Fed cutting or not cutting rate makes headlines for a couple of days. But when you think about it, if the Fed cuts rates once or twice or no times, I mean, at the end of the day, who cares? It's de minimis. It's not. I mean, the Fed raising rates 500 basis points.
Yeah, that got your attention.
That got everybody's attention. The Fed cutting rates 25 basis points or 50 basis points and then stopping, like everybody get a life.
Right. All right. In terms of getting a life on AI, a lot of I'll just speak for myself. I'm trying to figure out how much of this AI stuff, and I'm putting in air quotes here for our listeners, is incremental tech spending, or is it just taking some money from IT or other tech budgets and putting it to?
It depends on which
AI?
subsector you're talking about.
Okay.
So if you're talking about the semiconductor sector, where it's NVIDIA or AMD, it's massively incremental. If you're talking about overall tech spending, at this point, not clear. What is pretty clear is that companies like some of the IT consulting companies have no revenue growth because it's taking Peter to pay Paul.
Yep.
So, and software, unclear. So it's only very clear in hardware.
Mm-hmm. Let's overlay the presidential election with these theses. Thesis?
Thesis.
Just thesis is plural and
With the
singular?
ES, I think, maybe.
Okay.
Okay.
It's important. I took Latin for a while.
Theses, but this is a thesis. What these C's.
Okay, so what is your prediction for the election? And how does that impact? Because a lot of what you're talking about is driven by fiscal policy.
Okay, so let's backtrack for a second. So first of all, caveat, whatever I'm about to say, I am not speaking for Neuberger Berman. I'm speaking just for myself because I don't want to get into trouble. So it's May 7th. We're how many months? 5 months, 6 months from the election?
Mm-hmm.
Very far.
And as far as I'm concerned, the election is baked. It's done.
Which is?
And Trump's going to win. And I think he'll win every single swing state. And this is how it's going to play. So at this point, the protesters, and what I'm about to say has nothing to do with who I'm going to vote for, what my predilections are. This is just pure analysis. The protesters on the college campuses have rapidly become the face of the Democratic Party. Not completely, but that will be solidified because I am 100% sure that in August, at the Democratic Convention in Chicago, irony, when you think about 1968, they will all be protesting there, and they'll be screaming and yelling, and they'll be screaming and yelling a lot of things that are anti-American, and the country is going to be appalled. And at that point, it'll be very, very clear that Trump will win. But as far as I'm concerned, this reminds me a little bit of August 2007. If you look back at the financial crisis, the crisis took place in the fall of 08. But in August of 07, subprime paper had collapsed. The crisis was baked in August of 07. The rest was just an inevitable play. So I kind of feel about the presidential election right now. It's baked, but the only people who don't know are the voters.
All right, we'll see how that plays out in the marketplace. Steve Eisman, thank you so much for joining us.
Back.
Steve Eisman is a senior portfolio manager at Neuberger Berman, joining us live here in our Bloomberg Interactive Broker Studio. Let's see where this economy's going here. Francis Donald's going to help us out with that, chief economist at Manulife Investment Management. Francis, thanks so much for joining us here. I'm not really sure where the market is here in terms of this Federal Reserve. For a while there, we started out with a lot of rate cuts factored into the market, then fewer and fewer and fewer. And then there was even talk of a rate hike maybe. That seems to be off the table here. I'd love to get a sense of how you folks at Manulife are thinking about our Federal Reserve and kind of how they're thinking about this economy.
You mentioned two words earlier. We have two words too. Fed cuts are going to come later, but then much faster than this market has been pricing in. Now, we've already been seeing that later to a certain extent, and that's just simply because we do expect the labor market in particular to decline. We do expect inflation to decline, but we have a few more months before the data will give the Fed permission to begin this easing cycle. What we haven't bought into is that this would be like a 2 or 3 year done situation, that these would be insurance cuts. We believe we are heading into a proper downturn that will require a proper easing cycle. And frankly, that call, is this just, some insurance cuts on the margin, or are we going to see a average historical easing cycle, is far more important than do they go in June, September, or even December in our view.
So your two words are later and faster, basically. What gives you the confidence that we will see a material downturn?
Leading economic indicators. So just about everything in the labor market that explains where we are in the labor cycle is pointing to a deterioration. And we're not calling for the end of the world. We're not saying it's a big crisis. We're calling for 2 quarters of negative GDP, Q3 and Q4. Could be Q4 and Q1. We'll know as we get closer to it. We've got, business employment development data, 9 million companies telling us there were job losses last year. Household employment has been flat. Temporary employment, really good leading indicator, flashing recessions. Average weekly hours worked in the economy. Just how many hours are people working? That's back to pre-COVID levels. Quit rates are dropping. Surveys from PMIs to small businesses say we're just not hiring as much anymore. I mean, I tell my team, we've been calling for a recession for a while. It's been later than we expected, but I say every day, come into work, look at the data, and just ignore your past call. What does it tell you? It tells you we're late cycle, and the odds of a downturn are much higher than the odds of a reacceleration from this point.
We're hearing a similar type of commentary coming out of the Walt Disney Company. I'm reading the research React from Bloomberg Intelligence, Geetha Ranganathan. Disney commentary on a normalization of demand at the theme parks will weigh on sentiment even after the segment posted a solid 12% operating income in fiscal Q2. Guidance for the parks in Q3 is weak with no growth, suggesting full-year estimates might be at risk. So there's an example, Francis, of a data point suggesting maybe the consumer's strength is kind of waning here. Is that where you think you might see it from the consumer per se?
You're likely to see it across businesses and consumers because that's how rate hikes work. The average time between the first rate hike and its impact on businesses and consumers is 2 years. So we're not exiting the period in which rate hikes become really impactful in the economy. We're entering that period. The mistake was in thinking that we'd see the impact earlier because of how fast and intense the rate hikes came. We're just entering that period. This is old-fashioned economics. When money costs more to borrow, you borrow less of it and you invest less of it. Consumers can borrow less, they can spend less. Now, I will say there's a really important component here, which is that we are seeing a big bifurcation amongst both businesses and consumers. The spread between CEO confidence and small business confidence, largest that we've seen in this data history. And for consumers, high-income consumers, they feel everything is fine. Why? Because they're benefiting from higher rates and a good stock market. Low-income consumers telling a different story. So I love a good quality stock picker, even as a macro strategist in this type of environment. It's going to be a little bit trickier than just looking at the aggregate. There are some elements underneath the surface that are telling slightly different stories.
Well, I think that's such an interesting point, too, especially because the high-income consumers also have those low mortgage rates, right? So they're also benefiting from that. Lower-end consumers may not be owners at all. So I guess my question is, and this is where it kind of ties to Disney also, is this a real retrenchment or just we had so much spending, we had so much, say, theme park attendance, if we use Disney as the example, and we're just moving off that high level? Is there a distinction to be made?
So I love this question. Are we just heading towards a normalization is effectively what I think about. If you look at the year-over-year charts, most of them signal this is a really strong contraction. Things like the SAM rule or a lot of things showing the unemployment rate is 10% higher. Does that work when we've just come off of really low bases or really high highs? I'm a second derivative gal. I gotta say, most of the time, momentum in year-over-year is the powerful indicator, but there is a chance that we're simply normalizing down to regular levels. And this is why we're not calling for a huge crisis. We're just saying that your GDP can be negative for 2 consecutive quarters, and the Fed may want to begin an easing cycle in response to it. But this is a post-COVID, completely no precedent type of economy. And so I think there's a fraction of this that has to be old-fashioned economics and what are standard relationships. And then we have to overlay the more subjective, what could be different this time. You need a little bit of that science, a little bit of that art.
Francis, what do you think about the labor market here? Again, it seems to have been so resilient for so long here. Are you concerned that there may be some cracks in this labor market, or do you think this economy can continue to support maybe a sub 4% unemployment rate?
We're pretty close to 4. We'd have to stay at 3.9% now through the rest of the year, which seems a little tricky. So I think, again, you have some old-fashioned components here. If you look at temporary employment, average weekly quit rates, hiring rates, even conference board confidence data on jobs hard to find minus plentiful, check the service employment index under the services PMI. That's deteriorated to levels that we've only really seen in really serious recessions. These are not signaling that the employment is going to get better. They're signaling a further deterioration. At the same time, we have a very pronounced labor shortage.
Yep.
We are in an environment where businesses, it was a heck of a hard time to hire people in the past few years. They've said, if it's only a short-term recession, we're going to hold on as long as possible. So I think you have a mix of, yes, things are going to get worse. Are they going to be a really standard massive deterioration? I don't think so. You got to overlay that structural post-COVID economy as well.
Francis, thank you so much for joining us. Again, we always appreciate getting your thoughts and commentary. Francis Donald, Chief Economist at Manulife Investment Management. All right, folks, your daily look at the front pages around the world. Mr. John Tucker, newspapers. A lot of them out there, not as many as there used to be, but a lot of newspapers out there. Although you go to an office in London. Let's say you have a meeting in an office in London. You go into the waiting room, dozens of newspapers on the table. It's still big in London.
It's an interesting. You go down to City Hall. Room 9 is the press room, and outside is a plaque of all the newspapers that have gone out of business in New York City.
Yep,
and
all right.
it's a big list, and it's kind of sad.
Well, I don't know if you guys know that, but you can also get papers on the interweb now.
Really?
Yeah.
Really?
Isn't that amazing?
I'm going to tell Carol Massa that she doesn't have to print out every single piece of information, that she can have it like maybe on her screen.
Okay. Well, let's start here. If from the Bloomberg this morning, if you want to get somebody's attention on Wall Street, what do you say?
Bonus.
Or if you want clicks on the Bloomberg terminal.
Oh, I can imagine. After 2 pretty lackluster years, they are set to jump, especially on desks that help companies tap markets or trade their bonds. According to a report today from the compensation consultant Johnson Associates, bankers who underwrite debts may see payouts swell as much as 25%. Deals picking up this year. For bond traders and equity underwriters, the incentives may rise 20%. Alan Johnson is the managing director of this firm. He says, in general, employees in financial services should be pretty pleased. And this is way too early to be even talking about bonuses. I've had managers come in when I sit in my bonus meeting, and we ripped it the entire year. Some knucklehead lost $200 million in like the last week of the year, and that is the excuse my boss is like, we're not going to pay you. Like, what?
So I mean, stinks.
Yes, the average cash bonus that declined 2% last year. It was $176,500.
Maybe they're like, just please don't go to a hedge fund or something.
Right.
Yeah, but explain to everybody, you live on your bonus.
You used to. I mean, back in my day, it was 90 to 95% of my annual compensation was my bonus. That's changed. Now they make it much more your salary versus your bonus, but still the bonus is material.
99% was your bonus?
Yes. Yep.
Holy moly pants.
Yep.
All right, let's do this one from the Wall Street Journal. Kind of skipping around here. Men happier at work than women.
No.
That's how they feel overall about their jobs. Most workers are positive. You dig deeper, though, you find about 65% of men say they're happy with their jobs compared to 60% of women. The largest gaps in satisfaction between men and women related to financial benefits, despite many companies introducing more family-friendly policies such as daycare at work, mental health services. The women surveyed were less satisfied with their jobs than men for the 6th year in a row. Women in particular might sense a more profound loss of remote work benefits as employers continue to push for their employees to show up more. And of course, I'm going to harp on this because I always do. Child care for moms is especially tough. And when you're a single mom, it can be like devastating.
Right, and we know. Yep.
I'm shocked. I'm shocked by this survey.
Well,
shocked,
no, I think
I
think a lot of people at the top might be shocked or maybe uninformed.
Really? They should talk to people, and it wouldn't be so shocking.
I mean, I remember, when Matt Miller came back from Germany for Bloomberg, he worked in, and he was, again, kind of, it just shocked him to come back here and to say, oh, in Germany we had just wonderful health care, it was free of charge, blah, blah. Now he's paying $1 gajillion and his daughter is in like the basement of some church in Westchester. Paying $1 million a year. Crazy.
And that's a good slot.
Yeah, that's a good slot, and that's a good slot.
Super good slot, yes.
So very tough. Okay.
All right, let's do this one also. What happened to the tax credits? More governments are slapping fees on electric vehicles, reporting for Bloomberg this morning. We all thought governments were trying to encourage the use of EVs, but the shift away from combustion engines, that is actually leaving a $110 billion hole in government revenues owing to a drop in receipts from fuel taxes. So you'll have a lot of states and governments across the world among jurisdictions introducing tax changes and charges on EVs and hybrid vehicles designed to raise funds and compensate for the declines in gasoline and diesel excise taxes.
So to this point, actually, I think there was an article in the FT yesterday that talked about in Germany in particular, they're rolling back some of the subsidies that they gave, not just for things like EVs, for example, but like heat pumps and stuff like that. So consumers spend a lot of money to then get a rebate, and then all of a sudden the rebate goes away. They don't know if they're going to get it or not. They wouldn't have done it otherwise. It gets complicated. And the idea that the government will have to spend money to make all this work, full stop, period.
Yep.
And we'll conclude with this one from Bloomberg. Oh my gosh, Taylor News. Apparently, the Paris Olympics is drawing luxury travel demand, but guess who is the bigger draw?
Tay-Tay.
This week, the superstar playing 4 shows at La Défense Arena. This is just outside the capital, so kicks off the Eras Tour, the European part of it. total seating capacity of 40,000 per show. So this event is just a fraction of the size of the Olympic Games, and yet the concert's drawing 5 times as many Americans as the Paris Olympics. This according to the luxury travel agency Embark Beyond. Embark's co-founder, Jack Eisman, tells us that she's overshadowing the Olympics, that among the more than 200 Paris trips that his company has planned for Swifties, the average length, 3 nights, clients usually staying at luxury hotels. Around a third of the groups are mother-daughter pairs who want to schedule shopping sprees around the concerts.
I looked. I was telling Tucker earlier. I looked into this, just for fun, and it would be cheaper to go to like Sweden and see the concert, or even Paris or the UK and see her concert, than to go to Miami.
Yep.
In terms of the ticket prices, just putting that out.
But I'll note over the weekend, who drew like a gajillion and one fans down in Madonna? Where was she?
Oh, Brazil. Wasn't she in Brazil?
Like Rio.
You asking Tucker that question?
Yeah, exactly. But I mean, Madonna still, I mean, like hundreds of thousands of came to see her concert down in Rio.
Dude,
like,
she's Madonna.
She is, Madonna. All right, and that was John Tucker with our newspaper segment. This is the Bloomberg Surveillance Podcast, bringing you the best in economics, geopolitics, finance, and investment. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show. Weekday mornings from 7 to 10 Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen. And as always, on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.